Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. The market has crushed a lot of stocks in 2022, but that means that some really great dividend stocks are getting really cheap. And so we wanted to highlight a few of these for you. To do that, I asked Jon Quast to join me. Jon, how are you doing?
Doing fantastic, Travis. Thank you for having me.
Before we get there, I do want to ask you if you would follow the Rive Investing here on YouTube, subscribe to the channel. It really helps out the show. Give this video a like and leave any comments that you have below, and we will try to answer those. Jon, I'm going to let you go first. What is the first cheap dividend stock that you want to highlight today?
So let me preface this by saying you can find higher dividend yields. And so what is a yield, right? If you invest $100 in a stock and it pays you $3 in a dividend, that's a 3% dividend yield. You can find much higher dividend yields than what I am about to share. Just go to any stock screener and just screen out the highest dividend yields. The thing is, though, a lot of times the yield is high for a reason, and it's not going to keep being paid out. And so you do need to be aware of that. This one is a high yield dividend stock, maybe not the highest yield, but very, very high and historically high for this company. And that is Advance Auto Parts, symbol AAP. 4.3% dividend yield right now, by far the highest the yield has ever been for this company. If you're not aware, this is a retailer across the U.S. that sells used car parts mostly to consumers, like regular people like me who are DIY mechanics. However, they do also have a very robust professional business. And so if you have a shop, you might work with Advanced Auto Parts to make sure that you always have exactly all the parts that you need. They do so own some other brands as well under the portfolio in the company of Advance. But as I look ahead, I really think that the market is trending towards used cars over new cars. And so specifically, what am I talking about? I'm talking about interest rates. They've gone up the fastest that they've ever gone up in the U.S. That is making it more expensive to buy buy any car, but to take out a loan on a car. And so I think that favors cheaper cars and cheaper, older, used cars. I also look at things like the prices of used cars. So you can look at something called the Manheim Used Car Price Index, and it basically shows a relative pricing of used car prices. Right now, it is astronomically high, higher than it has ever been. It has come down a little bit recently, but this index is telling us that used car prices have much further to fall in price over the next year or even couple of years. I think that also points to a more affordable used car market. I think that favors the used car space. And if people are buying more used cars over new cars, I really think that favors a car maintenance company like Advance Auto Parts. And so the company, like I said, paying out a dividend now, it's paid it out for 16 straight years. Now, it hasn't raised it for 16 straight years. It's only raised it for the last 3. Paying out 70% of its earnings right now as a dividend, that is a very high payout ratio. However, I don't believe it's in danger of being cut. If anything, I think that they'll maintain it at what they're currently doing, but maybe a small raise. But I think that the business is a lot more stable than people are giving it credit for, and I think the used car market is in for a much better year than what people are expecting.
Yeah, I mean, people are just going to start keeping vehicles a little bit longer than maybe they were planning to. I put myself in that boat right now. So I like that one. The one I wanted to highlight is, I've been harping on this one. The market has proven me wrong, but eventually I will be right. Verizon is just too good a dividend to pass up. Right now, the dividend yield is 6.9%. The stock's price to earnings ratio is 8.1. And their payout ratio, which is the percentage of their earnings that they're paid in the form of a dividend, is 55%. So why do I bring that up? Like you said, if a company is paying out 100% of their earnings in the form of a dividend, it means that they don't have any money to put back into the business and grow the business. Verizon is still keeping about half of the money they make from earnings, and they can use that to buy back stock. They could use that to buy spectrum, pay down debt, which they're starting to do. I would like to see them do more of that. There are a number of reasons that the market doesn't really like telecom stocks and Verizon specifically right now. They're starting to lose some market share to competitors, AT&T and T-Mobile, from the smartphone space, the connections that they have. But I think that's really important to hold on. There are only 3 major competitors in the US. That's called an oligopoly. Typically, oligopolies have very high margins. These businesses sort of, they just trade customers back and forth over a long period of time. And they kind of have a, wink, wink, nudge, nudge, hey, we're all going to make plenty of money here, kind of a setup. It's just the way it naturally forms out in an oligopoly. This is why the regulators typically don't want this to happen. But in wireless, it's so expensive to buy spectrum and build out the network that's just the way that it's played out. So I think from a long-term perspective, they're in a really good position. The other thing that I want to add is they're starting to add 5G wireless broadband customers at an extremely rapid rate. What is that? That is, instead of using a hotspot on your smartphone to connect to your computer, you now have a box that is effectively a little hotspot, 5G hotspot in your house or in your business. They're now adding customers to the tune of hundreds of thousands per quarter for this 5G broadband. And I think that's going to both expand their customer base and also make them much more sticky to the customers that they do have. So you start to bundle together your smartphone connection with your broadband connection, now add in some streaming services, and now you have the new cable bundle, except it's wireless. I think that's really where the future of telecommunications is going. Verizon is one of the leaders in the space, and I think is the cheapest of these stocks. So I will take this 7%, nearly 7% dividend yield all day long. And I think it's a very cheap, underappreciated stock right now. What do you have next for us, John?
Well, we're going to go to the other end of the dividend spectrum here for dividend yield. There is some subjectivity on what qualifies as a high yield dividend and not a high yield dividend. I consider anything under 2% as not high yield, and Tractor Supply Company would fall in the low yield category at 1.8% currently. However, Tractor Supply Company, that is, historically speaking, a very good dividend yield. Typically, it's not this high. So that's why I'm putting this in the cheap dividend stock category, because typically you don't have it this good. Also, with Tractor Supply, I'd argue that it's normally not this high because it is such a high quality business that is very, very good in any economy. And here's what I mean by this. A very, very large percentage of its sales are in items like animal livestock feed. And this is an expense that for many, many people, myself included, who has animals that qualify as livestock, I don't care what the economy is doing, you still find a way to feed your animals. It is part of what you are doing. Even if you're not doing it for profit necessarily, you're not a full-time farmer, but you have a hobby farm or you have a little bit of something going on at your property, you're going to keep paying for your animals. You're going to keep them alive. You're going to keep them fed. Absolutely. The other large percentage of their sales comes from agricultural equipment and tools and seeds and things like that. Another thing that people are going to continue spending on in whatever economy, very large percentage of its sales come from loyalty customers as well with Tractor Supply. So it's a very, very stable business year in, year out. So you don't expect anything to happen there in the coming year. There's a lot of uncertainty going into 2023. What's the economy going to do? Is it going to go up, going to go down? Doesn't matter. Tractor Supply is going to be a solid play, in my opinion. It's still going to make a lot of money in the coming year. Earnings might go down, might go up. Either way, it's going to make money. And you look, it has a very low payout ratio, only 35%, so plenty of room to grow that dividend. And speaking of which, they have grown the dividend now for 12 consecutive years, so paid it out and grown it 12 consecutive years. It is halfway to becoming a dividend aristocrat. And I don't think you get halfway to dividend aristocrat status without going the rest of the way. So in my opinion, 13 years from now, Tractor Supply will be a dividend aristocrat, and I want to be part of that ride the entire way.
This seems like one of those companies that's not going to be disrupted by some of the things that have just at least partially disrupted a lot of retailers over the last 10 or 20 years as well. I mean, I don't really see Amazon getting into livestock feed. Is that kind of a good way to think about it? This is almost
Absolutely.
a market where it's so old school that they're just going to be in their powerful position for the next 100 years, and nothing's really going to change.
Nobody wants to ship a 50-pound bag of horse feed, especially considering all the feed that a larger animal would go through. Now, I keep rabbits personally, so I mean, it takes us a long time to go through 50 pounds of feed, but people who have horses, cows, those kinds of things, even chickens can go through feed quite a hurry. 50 pounds, you're ordering that quite frequently. That adds up if you're shipping this stuff. So, yeah, I don't see this as being disrupted. It's something that continues to be a local kind of mom and pop's feel even. So Tractor Supply is a acquisitor in their space, consolidator in their space, buying some more smaller regional chains that have that still hometown-y feel. But even as a big chain, over 2,000 locations, they still do have that local sense to them. And I think it serves them well.
Yeah, I like that one. Definitely not the local homey feel. I'm going to go with Apple with my next one. Also not a high dividend yield. Right now, the dividend yield is 0.7%, but the payout ratio is only 15%. So for perspective, they could increase that dividend by 4x and still only be paying out about 60% of what they make in earnings. Apple's one of these companies that it's always shocking how little money they spend on things like research and development. I mean, they spend a ton of money on research and development, but their business is so big, their revenue and their earnings is so big that it's a very small percentage of revenue that they're spending on R&D. And it's such a focused company too that still only making a handful of products. The number of SKUs has increased over the years, but still smartphones is the iPhone is the core. And then you have Macs, iPads, and peripherals like the AirPods. But it's such a great business and such a sticky business that it's the kind of dividend that I just intend to hold for a very long time. And the stock has done so well that the only reason I've been selling a little bit in 2022 is because it became such a big chunk of my portfolio. And so it's like a portfolio management tool. But I just don't see over the next decade anything replacing the iPhone. It's a little bit like owning Microsoft, in the 80s or 90s, where it's just like, yeah, maybe something else will come along, but the computer is still going to be really important. So that's sort of where my head's at with Apple. Not a high dividend yield, like I said, 0.7%, but you do get that dividend if they choose to increase that payout, which I think they probably will over time. This has been a company that has been increasing returns to shareholders both through buybacks and dividends. I think that's going to be a positive trend for the stock. And it's one of those companies that's, you could buy it and just hold it for the next 10 or 20 years, and you probably things would work out really well. And so I just set it and forget it. Sometimes it's no more complicated than that from an investment perspective. So I've got two here that are very different from the size of the dividend yield. Verizon is paying almost 10 times the dividend yield that Apple is, but I like both of these dividend stocks. So those are my two. Remind us again, John, what were your two stocks?
Advanced Auto Parts and Tractor Supply Company.
All right. Leave any comments you have about those four stocks that you have, and we will try to answer those on YouTube. Follow Rive Investing. Give this video a like, and we will see you here next time.